And we have the Fed and the Treasury continuing to move ahead with plans to overhaul regulation of the financial industry. But University of Chicago professor Luigi Zingales says the government isn't thinking about the problem in the right way. Instead, his proposal would let the market regulate itself. And he joins us now from Bloomberg's Chicago bureau. Thanks for being here.
My pleasure.
So we've got some strong news from JPMorgan and Goldman Sachs. Does this mean financial firms are ready to live on their own without government support?
I think that means that some firms have the right condition to make a lot of money in this moment. I think especially if you are in the investment banking side of the business, interest rates are low, the market has gone up, there are a huge amount of trading opportunities. It's not surprising that Goldman and JPMorgan made a lot of profits in the second quarter. But if we look at the traditional banking business, even in JPMorgan is not doing that well. We have still a lot of losses on the consumer side, on the housing side, and the real estate sides. I think that we're not completely over yet.
Now, of course, we're not over yet. You think there's more pain to come? Could we possibly be following in the footsteps of Japan's lost decade?
I think there is definitely a lot more pain coming. I don't think we are necessarily in for a repeat of Japan, but I think that we still have banks that are weak, that are not fully recapitalized, and as you just described, they're not lending very much. Now, part of this reduced lending might be that there is not such a high demand because the economy is not doing that great, but there is a concern that the banks are not strong enough to do the lending that the economy requires.
Okay. And, of course, part of the administration's plan includes addressing banks that are too big to fail. You have a market-based proposal. Describe it for us.
Yeah, I think that there are two concerns in having a proposal for the too big to fail. The proposal number one is that whoever is in charge of making the decision is too slow in acting. Even now in the United States, the FDIC had the power to close down sort of bank subsidiaries, and they've not been very proactive in doing that. And in a sense, is understandably so, because there is a huge lobbying not to do that. So we need to have a trigger mechanism that induce the regulator to act. The second concern, which might be less severe in the United States, but I think is more severe in other countries, is the regulator might be too active or even politically motivated and go after certain banks because those banks are not sort of in the good eye of the president or the prime minister. And so we need to have an objective trigger mechanism to induce the regulator at least to start considering that the firm is in trouble. And the proposal that Oliver Hart at Harvard and I have advanced is to ironically look at the CDS market, the credit default swap market, as an indicator for the situation. Because with all the criticism of this market, and we can discuss that there are some limitations, but however, it's a very powerful indicator of the condition and the risk associated with the debt of a bank. So if we see the price of CDS going up a lot, this is a red flag. And I think that now the burden of the proof is for the regulator to say that the situation is positive when the CDS price is so high.
So let me ask you this. Isn't it dangerous to let CDS prices dictate which firms are actually on the brink of failure? Can't CDS prices be manipulated by speculators?
First of all, I think that the idea that the market will be manipulated is a bit aggressive. I think that especially if CDSs are brought on an exchange and they are properly sort of traded and transparent, I think the possibility of manipulation is limited. But second, our proposal is not that once you see the CDS price up, you necessarily have to act and jump and close down a bank. However, once you see the CDS price up, it is the burden of the regulator to explain why they decide not to intervene if they decide not to intervene. Because I think that we are playing a sort of an unfair game in which you have all the lobbying industry of the bank saying, you know, the situation is great. You will never hear an insolvent creditor saying that is really insolvent. Say it's a temporary liquidity problem. And banks have a huge incentive to delay because if the situation recovers, they can make a lot of money out of that. So they play a delaying strategy at the expense of the taxpayers, because we are in a world in which if you If they are lucky and they win, they get the gain. But if they are unlucky and they lose, we support the losses. And so I think that the purpose of the new regulation should be to stop this asymmetric bet early enough so that the taxpayers don't have to pay the bill.
Okay, very interesting proposal. Let's talk about the housing market. We have some signs that it is stabilizing, some more good news out today. Do you think the administration handled and is handling the mortgage crisis correctly?
No, I don't think so. There are two reasons why people default on their mortgage. One reason is because literally they cannot afford to pay the mortgage because one of them got unemployed, and so they can't afford the monthly mortgage. Another one that is used to be very rare, but now is becoming increasingly a problem, is when people realize that the value of the mortgage vastly exceeds the value of the house, and so they find very little reason to pay. And so they walk away. Traditionally, this was never the case because people were not so highly leveraged and because house prices had not dropped so much in the past. But today, especially in California or Florida, where house prices drop more than 40%, we have a significant fraction of the population, not only that they have negative equity in their house, but they have negative equity which is very large, both in relative and in absolute level. In relative level means out of the fraction of the house, they are down like 30% with respect to the value of the house. And in terms of dollar value, it can be 100, 150,000 short. And
so why aren't they defaulting?
Oh, there are moral and social constraints to that. In a survey that I conducted with a colleague at the Keller School of Management, we find that 80% of the American people say that it's immoral to default when you can afford to do that. However, the same people who think it's immoral to default, when asked if they were to do that, and you start to increase the size of the shortfall, most of them eventually say, yes, they will default. So there are definitely some moral consideration. There are also some social consideration. If you are the only one defaulting in your area...
I'm going to have to wrap you up. I'm so sorry, Luigi. Thank you so much for joining us with some very insightful perspectives on the housing market. Stay tuned for more right here on Bloomberg News.